Okay.
Cool. Yeah, I only saw a couple of people online. I'm not sure if more people will be joining, but
Yeah.
yeah. But if not, I mean, and that's the second thing I want to say. Congratulations, because the group has been, has been increasing massively. More people have been joining, so yeah, looking awesome, man. Looking
Yeah.
awesome.
The growth from the group is coming from everywhere, from other groups on school, from YouTube, from other platforms. And so far, I'm enjoying the experience. I mean,
Yeah, yeah,
I just have one module for the moment, and we're at 100. Even though, I don't know, I have the metrics, and I would say 80% of people are active, so they log in daily, something like this. But that's enough to have some interaction. And as I build this platform, module 2, 3, 4, and as we'll do more Q&A per week,
yeah,
I
yeah.
suspect there will be more activity. So yeah, so far
Sure.
that's good.
Yeah, but even though you only have one module, I mean, it's a really compelling module. It covers plenty of stuff, especially for beginners. So there's a lot of value in there, and I'm pretty sure, yeah, community members are going to be able to make the most of it. And yeah, I mean, when I started going through your videos, and I realized you're also following compounding quality, I was like, "What? Seriously? Yeah, seriously? Yeah." Because those guys, I like what I'm following them as well, even though I don't subscribe to their service, but I get all the letters. Those that are for members only, I can't read the whole thing, but still, yeah, what they deliver is quite complete. Let's put it that way. Quite compelling.
Yeah,
Yeah,
and they are very active on Twitter. That's where I follow them. And when I wanted to do this class on income statement, cash flow statement,
yeah.
I was looking for some Google image, some good examples, and directly you go to Google image, you see this big white and red table. This is from compounding, and all the good tables are from them. They are doing an extremely good work, so
They
kudos
do,
to them.
yeah. They put together really nice information. They digest a lot of the content. Some of that content is quite complex for people who are just starting off. So, but yeah, but I like the materials quite a bit, and I saved quite a lot of them, to be fair. And I sometimes even go through all the content just to make sure that I have the information well, like I have everything in my mind. Yeah, whenever I'm analyzing companies.
Oh
Yeah,
yeah,
Hugo.
they
Yeah,
have plenty of templates. Hi, Hugo.
yeah. Hi,
How are
Hugo.
you?
Hi everyone, can you hear me?
Yep,
I can
very
hear you.
well.
Okay. Yes.
Yeah, perfect. Hi
Yeah.
How
everyone.
are you?
I'm fine, I'm fine.
Awesome. Awesome.
Thanks
So, are you
for
guys?
joining the call.
Yeah, yeah, yeah.
Oh yeah.
Christopher, you a full-time investor, aren't you?
Yeah,
That's what. Cool.
exactly. I've just finished my business school, so finished education last October, I would say. And I said, okay, that's a good moment to go entrepreneur. If I just finished school, I don't have a job yet. I could apply for jobs. And with the current labor market, it's quite hard. So you have to put a lot of efforts to find a good job, whether it's in Paris or in the US or other European countries. And I wanted to do this project. I wanted to do like full-time investor stuff, some YouTube videos, and I said, okay, that's a good moment. I would not have maybe two opportunities like this without any
Yeah.
wife or kids. So it was a good moment, and I'm happy I did it. So now, for the moment, full-time investor.
Full-time. Yeah. Yeah. Exactly. So you took the jump. Yeah. I'm a bit different because I still have a full-time job, but I work on my business on the side as often as I can, as often as I can, really, because it's really something that I'm passionate about. Like you, I love like investing, but I didn't want to risk like quitting my day job without having something really solid, to fall back on. So for now, I'm just building um, building a very nice portfolio of clients, so I can then, yeah, take the leap.
Yeah, and you help people invest in the stock market. Do you do like a done for you complete guide, or do you give them the information and they just do it themselves? How do you help
Now,
them?
I help them out, so I'm hands-on as well, and I help them out going through everything from creating an account. So, for example, I have two brokerages. One of them is Interactive Brokers, and the other one is eToro. Well, actually, I used to have eToro, but right now, no, I still have that account, but it's an account that I only use. I used to use that account only for trading, not investing.
Okay.
And I want to transition because investing, having a long-term mindset, I find it a lot more profitable, frankly, because of the fees and all of that. It adds up quickly, and so I wanna pivot as soon as I possibly can. And but yeah, with them, so we cover everything from technical analysis, fundamental analysis as well. But fundamental analysis, I think, is the most important thing. But it's it's the thing that people usually are most scared of, right? Oh, accounting. Oh my God, it's so difficult. So it really puts them off. And they prefer technical analysis. Yeah, I don't blame them because, I mean, frankly, anybody can look at a bloody chart and say, oh, okay, this is a support line. I mean, yeah, it's not that simple. Yeah, you have a few, there's more to it than just that, but still, fundamental analysis requires more work, yeah, on our part. So,
Maybe
yeah.
longer, and maybe Hugo will disagree on this.
On what? On
But
the fundamental
on
analysis?
that fundamental analysis is the most important part of the research, and compared to technical analysis, that's a different game.
No. Yeah, technical analysis for me is it's a zero in the investment strategy. So when I invest, there's no technical analysis, there's no support, there's no anything about previous what the buyers did. There's nothing like that. But it's all about fundamental, all about analyze the business and also verify management and all that. But no, for me, there's zero. How do you use what's the word they use? What's the
Technical analysis?
yeah, zero technical analysis, yeah.
Technical
Maybe
analysis.
that's
So,
just the
okay.
main point of technical analysis. I'm almost similar to you. I never use technical analysis. I used to do in the past, like 6 years ago, some charts, some supports, and I found
Yeah.
some crosses, and I found it really fun and sounded really smart when I did this and compared to
Yeah.
what people on TV said. But after that, it's complete nonsense if you're not an expert on it. So maybe it's just some psychological support that you can find. Okay, the price is 200, and every time it was 200, it rebounded for the past 5 years. Okay, you have real support. But apart from this huge psychological aspect, all the charts that you can draw is just another job. You can't do both jobs.
Yeah. No, you know why? It's because technical analysis is suitable for those who have a more short to medium term mindset. So, and that's fine. But in the end, it's the intrinsic value of the company. So the price will follow like the intrinsic value of the company. So if the fundamentals of the business are improving, then the price will follow suit. But if you are really short-term focused, short-term oriented, and some people like to be in and out of the markets, and then technical analysis is suitable. I just find it more costly, frankly, because all those fees add up. You're going to have to take classes as well, and I think you can make a lot more money just in investing. Find a great business and let your money there, just compounding for the long term, right? Like, what do you guys think? Christopher, you've been doing this for many years as well, so.
Yeah, at the beginning, I think every beginner in investing tries technical analysis because it's more fun.
It's fun.
It's fun.
Yeah, you're right.
You draw your lines. You think you're quite smart, and if
yes.
in the first day, second day, you get some money doing this, you think, okay, I will never use my CV again. I have my job, technical analysis guy. And so I understand why everybody, when they start investing, they talk about technical analysis. It's very fun and with some great colors, some green, some red, like some dopamine, some big charts in your face. That's good. And once you think about transaction costs, exactly as you said, if you buy and sell, I don't know, 30 times per day doing stock trading, the transaction costs add up. And after 6 months, you compare your performance compared to the S&P 500. You say, oh, wow, that's a lot of fees. Like, wow.
Totally. Yeah.
So yeah, that's why people shift to the fundamental analysis part. And every big investor, I mean, even Warren Buffett started with technical analysis, and at 19, he changed the strategy to fundamental. So
yeah.
even
After
the
you
best of
read
the
the
best
book,
changed.
after you read the book Intelligent Investor, right?
Oh yeah, absolutely.
Yeah, he mentioned that.
Hi,
Scott
Scott.
raised his hand.
You raised your hand.
Hi guys, it's good to see everybody this morning.
Hi.
I got a question for you all. So this is interesting because recently this isn't the first time that I've heard people say that they don't take into consideration for technical analysis, and it's intriguing to me because I agree with what you're saying is that if you're investing in a company, it should be like for the long term and it should be about the fundamentals. My question would be is then when you do that, how do you know, like when do you make the decision to say, okay, I guess how do you determine what your entry would be in that stock if you don't use technical analysis?
Do you guys want to take it,
Christopher,
Eduardo?
yeah, I can share my opinion. So it's about the intrinsic value of the company, in my opinion. So, for example, I have 15 companies on my watch list, and I only bought one. That's Baba. Why? Because because I think the company is cheap compared to where it could be. So it's cheap compared to its intrinsic value. So I've determined its intrinsic value based on future cash flows, and then I just I decide to buy shares. And if you are doing that, support lines don't really matter, because if the price continues to come back down, and if you are really confident that you've calculated so the intrinsic value more or less correctly, so yeah, and you have a margin of safety, then you can actually add more to your position. That's what I would say.
Um, but but there has to be, so then what triggers you though? Um, there has to be something though that triggers you to say, okay, I'm gonna buy shares at 150 or
Yeah,
so
Yeah, the technical
what is it that triggers you to go, okay, now I'm gonna buy?
yeah.
the
So Christopher, yeah, you can answer. Yeah,
the technical analysis helps you figure out a precise price that you want to buy, and you have a very precise range at the price that you can buy. If you don't take into account technical analysis, you have a wider range, and the short answer is I don't know. The price is just cheap. It can get cheaper, okay, 10% cheaper, 20% cheaper. It's roughly cheap, and let me buy at this price. And if it drops more, I'm buying more. So the big idea is I don't know, because I don't have a precise good entry for the stock. But that's that's what the best investors say. For example, Warren Buffett never relies on technical analysis. For example, if you have a
yeah,
P ratio really cheap and you say this bank is cheap, I'm buying at this price, and if it drops more 20%, he's buying more. So if Warren Buffett has no precise number for investing, precise target to buy, I don't expect us to have a precise target to buy.
What
yeah.
about like
So
what do you when you look at like Apple, for example, it's kind of a robust company and it's had a little bit of a dip here. Does that kind of put that stock on your radar?
Yeah, if I can add something, if you want, I can show you. I can show you my screen and show you my watch list, and so maybe you can understand what we mean by the intrinsic value and the price that we would be buying at. So I can show you even Apple, what I said about Apple and what I project about Apple.
Sure.
So maybe I can share my screen. It's here. Here. Normally it should work. Can you see my screen?
I can, yes.
It's loading. Yes, yes. We see your screen.
Yes, I can see your
Yeah.
screen. Yes.
So some of them are maybe 6 months old, so I need to redo some of them of the analysis. I do one for now. I just do one per year. So I don't do all the quarterly analysis and how the earnings will evolve, but I just do
Okay.
one per year. I will do more afterwards, but for now it's just my first. I would say it's been 7, 8 months that I've done the analysis
Yeah.
all the way. Before I
Annual
was just
update.
reading books and learning about. So you can see here on the each column, each row, that I'm putting here the symbol. There's the price here that appears, and here is my value. So the value is the number, the share price that I'm willing to buy. So if it means that if Apple gets under this value for me, so under this price, I will buy Apple.
Yeah.
And then after in my list, I also ranked every company by for me, their quality. So basically, I would say that I will pick, if there's several on this list that are possible buys, then I will pick the one that is at the top. And I just work like that way. I just compare companies, and I try to find the one that is currently the best buy. So cheap plus good company. So here you can see for Apple, for me, the price that I would pay Apple would be 65. I'm really, I would say, conservative for now. I'm really not keen to do too much entries and going out of the market, and I'm just for now improving on my analysis. But if for me I had to give you a price that I would buy Apple, it would be 65.
Yeah, exactly. Which means 65, Scott, is the price at which you would be willing to actually to buy to make his first purchase. So yeah, and if it continues to go down, well, it's not a science, fundamental analysis, as you probably know. It's not a science, but it's an art, right? So it's a price range. You pick an intrinsic value range, and then you decide which price you are willing to make your first purchase at.
Yeah, so there is no precise price. It's just below 65, you're a buyer.
Yeah.
Yeah. And by the way, and this is for Google. Other investors have other prices, right? Because it depends on some variables like the discount rate. So Google, I'm not sure, you were saying you are conservative. I think I'm conservative as well. So for example, I use a 15%. That's my discount rate. So most investors use 10%, 9%. In this market, I want to use 15%. And that obviously makes those prices, the entry price, lower.
Oh yeah, definitely.
Yeah.
Yeah.
Interesting.
I do the same.
Yeah.
And
I always for now use 15%, and then we'll see. I'm not versatile for now. I'm not getting all I would say, the small details for each type of company. I'm just rough with my precision, I would say. And I'm just trying to compare companies if they are if one is better than the other and one is cheaper with my calculation than the other, then it's a buy, and that's the only thing.
That's a strategy that can work and that has worked in the past. You have Joel Greenblatt, you have the magic formula, compares ROIC and something like a P ratio, and just two metrics, just cheapness and return on investment. So don't worry about getting like the precise numbers, the intricacies. Just two metrics are enough for Joel Greenblatt, and this strategy has been performing really well, very well for decades. So yeah, you don't need to get a very thin brush and go to the exactly precise decimal, precise numbers. That's a very good strategy that you have. You just have a rough idea of intrinsic value, rough idea of the metrics. If the return on invested capital is 30% or 32%, it doesn't matter. It's roughly 30% and not 10. So yeah, that's a very good idea. And the more number of metrics that you have, the more metrics that you have to monitor over time, the heavier it will get. The research will cost you a lot of time. And for every quarterly reports that the company will release, you will have to check every metric that you have on your Excel file. So that takes a lot of time. And when you do your forecast, that's the second drawback of having too many metrics to monitor. When you do your forecast for your DCF or your Excel file, you will have many estimates. And on the other hand, if you only have 2 or 3 estimates, 2 or 3 key metrics, you can be sure of them, forecast them, and have a much more reliable analysis, I would say.
Yeah.
It's safe to say then that based on that list that he sent, that in your opinion, Hugo, the market is very overbought right now. You're really waiting for a little pullback here so that you can trigger some of those targets.
Yeah, as Damodaran said, one of my key, I would say, teachers for now, the market for him is overvalued as maybe 9 or 10%. And I would agree that for now, there's no real entry points on none of the big companies in the US. That's sure for sure. And I would say maybe not even in any company in the US, apart from the small cap that I'm not really too good on them for now. But for the US, I would say there's nothing right now that is at a good price. Otherwise, they are great companies, but none of at a good price.
Yeah, some sectors are not overbought really, but I'm not really interested in that many companies. So I speak for myself. And so I have about like those 15 companies on my watch list, and I'm just waiting for them. They are all overpriced, yeah, for me at least. So yeah, when it comes, I'm gonna go all in, and yeah, that's the good thing. I mean, we have patience. Yeah, we can be patient. We can wait. Yeah.
Just Scott, out of curiosity, what is in your watch list right now? If you say you're waiting for a pullback, what are the current opportunities that you monitor right now?
Well, I guess I'm a little bit different because I do options and stocks, but the things that are on my watch list, like I got, like a Tesla and Apple, but it's very an eye-opening thing that Hugo shared. I appreciate that, his view there, because that opens my eye to, I agree that the market is overbought and that a pullback is probably imminent. And so you have to be careful that you're not long on any of these positions if it does pull back.
Yeah, I mean, for Apple and Tesla, maybe you can expect more than a 10% pullback. Apple is at the moment so big, and I would say it's very hard to go long Apple right now. The company is 2 trillion, 3 trillion. If you expect a double for the company, if you expect double, it means that the company would be worth $6 trillion. And
exactly,
that's a lot. The GDP for France is 3 trillion. So 2 times France. That's a lot. That's a lot.
That's why I would never buy Apple at these levels. I mean, it's crazy. I mean, to expect Apple to double from these levels is just insane. Yeah. And it's even if that happened, which I really doubt, it wouldn't happen in the next 5 or 4 years. So your rate of return wouldn't be like attractive at all. So it's not worth it.
Yeah. The other big opportunity was obviously Meta in the past few months. And when the stock was trading at, I don't know, 500 billion of market cap, it's an easy double to 1 trillion. Okay. Maybe 2 trillion is reasonable for Meta, maybe 3 trillion, but same, 6 trillion is just too much. And for the biggest companies in the world, just too hard. And for Meta, you had this opportunity for a big company, big profitable company worth 500 billion. You can understand Meta being a $1 trillion company.
Yeah, you bought Meta when it was trading on the cheap, right, Christopher? I missed it. I can't believe I missed it. Yeah, Meta was trading at $80. I can't believe I missed it. Yeah,
Yeah, that was crazy, and I understand everybody who panic sold because the news and all
yeah,
the fin tweet that you see on Twitter, all the hate, all the drama,
mhm,
everything happened. Everybody hated Mark Zuckerberg.
mhm,
TikTok was getting a lot of traction.
yeah,
Monetization was really bad on Meta, and people were leaving, bad campaigns. You had maybe 50 arguments to be bearish Meta. And you had the change of name, Meta Platforms, out of nowhere in 2021. And since the change of name, the Meta, the VR headset that is burning billions and billions. You had many arguments to be
yeah.
against Meta, and so I would not say it was an easy buy because of all the psychological effect and the pressure you had. Maybe,
But the business the fundamentals were still amazing. They
oh
were a
yeah,
very catch-rich business still, and yeah, I mean seriously, it just the rebound happened in such a short period of time. So what happened? Did the fundamentals change like that much? It's just yeah, crazy.
no, the fundamental didn't happen. What I think happened is that Mark Zuckerberg said, okay, guys, we will do the year of
Of
efficiency.
efficiency.
Let's
Yeah,
do
I know.
some layoffs. And I think they laid off 11,000 people. So maybe, I don't know, 7% of the company, 10% of the company, something like this. And since the CNBC article of the layoff was released, the stock get maybe 10% up in one day. And this was the start of the run that we've seen from $80, as you said, to 500. But
Ridiculous, amazing,
just
crazy.
the sentiment changed, the tone of management changed, all the fat that Zuckerberg had in the company, everything get cut, and it as if you had some fat and you start running and you start eating less calories. The business did exactly that in 1 year. So that's quite remarkable. But if you thought that you had a deal and bought the business at 200 or 150, and then it gets cut in half again,
It's
it
true.
will
Yeah, you're
cut,
right. Yeah.
cut your losses. I'm out of this game. Zuckerberg is an
Mhm,
asshole. You can tell, you
mhm.
can say everything you want and get out of this stock. So for all the people that endured the stock decline for, I don't know, 1 year, 2 years, it was not an easy double as some people say.
Yeah,
The hate
yeah.
was just insane.
It's like in China right now with Baba as well, even though Baba obviously is trading at such a low valuation. It's just amazing. But I mean, it's just a catalyst, just a small thing is enough for us to double our money at these levels. Because when it runs, I think it's going to run massively. And but yeah, obviously there's risk as well. But yeah, the compelling case for Baba is, I mean, the case for Baba, the investment case for Baba is really compelling. So yeah, we'll see. But I'm
Yeah,
confident.
yeah,
Fingers
there
crossed.
are many arguments to be against Baba. Same thing.
I
The
know.
stock has been cheap for months and months and months. If you take a look at the balance sheet from Baba, the stock is trading at $80 per share,
And
something like this.
yeah,
You have on a per share metric, $40 per share. So half of the company is in cash or
cash.
cash,
Yeah,
cash-like instruments.
cash
And
cash equivalents. Yeah,
exactly. And the company generates so much cash flow. It's equivalent to, I would say, $10 per share in cash. So 3 times free cash flow if X cash. If you remove the
yeah,
cash, 3 times free cash flow, 4 times free cash flow. That's crazily cheap. That's crazily cheap, and that's crazily hated at the same time.
true.
I think we have a question from Scott. How do you guys manage your capital that when those companies on your watch list reach your target, you have enough money to buy? That's a good question about the cash allocation that you need on your portfolio. When you, for example, for Hugo that wants to buy Apple, and if Apple reaches a target price of 65, if he's fully invested, he would not have the cash. In this situation, either Hugo can sell a stock that he has. He said, okay, it's overvalued, it's time to go out. You sell a current position to buy Apple, or Hugo can have some cash on his side, in his account, like 10% cash, 20, 30, 50% of cash, because he expects the pullback. He expects the market to go down, so he's prepared for this. The investing is about preparation and patience, so you can have some cash instead of being fully invested, maybe 20% cash, 10% cash. So if you have a good opportunity, Apple drops to 55, a major crash, you can have your 10% cash and get to work. What do you guys think?
True. Yeah. You know, I think and this is something that I also like about your investment philosophy, Christopher, is that I don't think you are a value investor, you are a quality investor, right?
Oh,
And
yeah.
this is yeah, exactly. So the guys at Compounding Quality, they have the same mentality, which I love. And so if you really find a great business, and if the fundamentals keep improving year after year, there is no reason to sell the company, because you are going to end up buying another company which is just average. It's very difficult to find a business that is just amazing. And some of the best investors in the world are just like that. They are not really value investors. Look at Munger. Munger cannot say he's a value investor because, I mean, he's still holding Costco at a PE of 40 or 45. Costco is a retailer. What the fuck? If you were a true value investor, you would have sold it. No, he's a quality investor, right? So he's just riding the wave, because these businesses are just, yeah, once in a lifetime opportunity, and I want to do the same. Yeah, if I find a great business, I only want to sell it if the fundamentals start deteriorating. Yeah, something like that. Otherwise, yeah.
And these businesses are never cheap. And I saw
Yeah, I
a
know.
tweet the other day saying we've all been waiting for a pullback for these quality names, and we just want to buy them at a good price, PE of 20, but we never have the opportunity. So we just wait and wait and wait, and the pullback never happens. So one guy on Twitter said, I want to build a portfolio of all these overvalued companies, PE of 50, 60, and just trade the portfolio and see how it outperforms the global market over time. So maybe even though all these companies are overvalued right now, in 10 years, they will outperform the market because they are so good, so strong.
Yeah. But the opportunity will come, Christopher. Look what happened to Amazon not long ago. Look what happened to Netflix. Netflix crashed 70%. It was trading at a PE of 15. Same thing with Meta. So the opportunities don't come around often, but that's what I was saying. When they do come around, you need to be really prepared. Yeah, and just attack. Yeah, because it's a massive opportunity. But yeah, you're right. It doesn't come around all the time. They mostly trade at ridiculous prices, so we have to be patient.
And that's a good point for Scott, to build your watch list over time so you can be prepared. And if you don't see many opportunities, maybe have some cash, 10% cash. Don't be fully invested. And if you build the watch list, as we've seen with Hugo, you can bounce on the good opportunities, because I think Peter Lynch said that some correction will happen every 2 years and some major crash every 6 years, something like this. So every 2 years, you can expect some things to happen. We've seen in recent years, 2018, some Trump or tech drama. In December, everything crashed 20, 30%. In 2020, you had your COVID crash. In 2022, you had something and everything plummeted 20%. In 2024, for this year, we will see. We will see. But on average, every 2 years, you have an opportunity, a good opportunity to swing if you play baseball.
True.
Just on a quick note, I think the free Zoom call will end in 2 minutes. But what we will do, because this conversation is cool, we can continue this call. I will just put an end to it. Click back on in 30 seconds. Let's just say, guys, that in 1 minute, let's just click on the same link and we will join the call. Okay.
Let's do it.
I'm reading your question, Scott. I will answer it. what website they use to find the Apple EPS right now. Okay, we'll get back to it. I'm ending the call right now, and let's go back in 1 minute. Click on the same link. Okay.
I'm back. Yeah.
It's working. Ça marche. It's working.
If we have time afterwards, maybe we can. If you have names for my watch list, which I could add, I would gladly look at other companies, because I think I don't have that many great businesses in my watch list, and there are so many that I don't know about. So Christophe often ask Christophe to give me all these I would say all these names of the great companies that often lead the market in several um, diverse fields. But I don't know most of them, and it's great just to, if you have any companies that I should add to my watch list, then I will add it.
Yeah, sure. You tell me the industry, I will have my favorites. Not on every industry, maybe 5 or 6 industries. We will
Yeah,
have 2 or 3 bullet points with companies. That's good. Just to answer the question from Scott, if you want to look at Apple's financials, you have several websites when you can see the EPS. I don't know what you guys think, but I like to use Yahoo Finance to find the most basic stuff. So for stock price, volume, or PE ratio, Yahoo Finance, you just type on Google Yahoo Finance, Apple, and it will be very easy. You will have the current EPS, the forecast for the EPS of next year. And I think that's the easier website you can. What do you guys think?
I use Yahoo quite often as well, and I use stock analysis as well. These are both free. But in the case of stock analysis, they only have US stocks. Yeah, it's a bit narrower, but still, I mean, you can find plenty of companies there. But these are free websites. Then obviously I use Stock and Walk as well, and the insights feature is just crazy good. Yeah.
Oh yeah, absolutely. Maybe I'll just yeah, go ahead, you go.
Yeah, I don't use any EPS or any of those metrics. So I don't look at them. I just look if they beat their expectations, but I don't look the numbers, and I just don't care too much about them. So
You don't look at earnings per share.
What?
You don't look at earnings per share. Why? You don't.
No, I don't look at this metric. No, not at all. For me, it's too easy to lie about it. I would say that earnings, sometimes they can, I would say, push up their earnings numbers by
they can, yes. It's
putting
easier
any
to
new yeah. So I prefer not to use it. I don't think I need it for now, so I don't use it. I just look at if they beat their expectations, and that's all.
That's important what you said, yeah, because these companies they always come up with new ways of manipulating the earnings. Yeah, so free cash flow is a lot more reliable. Yeah, so I like to look at free cash flow more, in book value as well. But yeah, you're right. I look at earnings, especially the history of earnings per share. But you're right. Yes, it's they can easily manipulate them.
You can look at the history to know roughly how it evolves. But I would say the thing is that everyone is looking at EPS.
You're right.
Everyone knows that everyone is looking at EPS. So if you only look at one thing, it's the only thing that they will try to cheat more on. So if you just don't look at it, then you avoid, I would say, the simple mistakes of getting crushed by stupid motherfuckers from Wall Street.
Or there is definitely a herd mentality on EPS, and every analyst on Wall Street focuses on this. Let me just share my screen real quick to just show, because that's recorded. I don't know if you see the Zoom recording that is processing right now.
Yeah.
I'm on Yahoo Finance, Apple right now, and you have this line of PE ratio and EPS. So that's quite quite easy to look at. And I think Scott had another question for you, Hugo, regarding your target price. How did you find 65? So I think you will have to explain what's your valuation process, either you do a DCF or just a multiple ratio.
So I always do a DCF. I never do any other methods. I don't know if Scott, you know what DCF is. Maybe you need to explain that also. I don't know if yeah, DCF, discounted cash flow. So if I had to explain, first I put some numbers in I have a spreadsheet that I created. I put some numbers in, earnings, cash flow, then I calculate some other metrics like cash flow for owners. I don't know if you know about it, a bit more advanced. And also ROIC that I calculate, so return on invested capital. So several small numbers that I calculate, also look at debt to equity ratio, some other things that could be trapped and how do they evolve their acquisition. So I put all of those numbers in. Once I have all of that, normally I have a cash flow for owners, I would say. So it's different than the free cash flow, but if you want, you can also take the free cash flow and know that you're not, for me, completely right, but you can adjust a bit. But you can use free cash flow. So free cash flow is in the balance sheet, if I'm right, Christophe?
Well, you can go to the cash flow statement. To have your free cash flow, you take the rough
I can show
valuation
you even
is
on the
cash flow from
platform that
operation
I use.
minus
I can show
capex.
you.
Oh yeah,
I can show you. I will show you directly.
perfect.
Right. So here you go on Seeking Alpha. So here is where I get all my numbers. So I know that Christophe shared 2 or 3 other websites where you can have a great all the data that is available. So let's look at Apple. And here you go on financials and cash flow. And here, if you go down, there's cash from operations. So I would say for me, it's everything starts from here, or most of my work starts from here. So there's cash from operations. And once I have this cash, I tweak it a little bit to adjust for, I would say, their misbehaviors, or if they are using their cash pretty well or not. I try to have something that is standard for all of them, for all types of companies, but is rigorous in trying to find how they are swindling me, how they are trying to trick me.
Okay, so you take the cash from operation and adjust for every other metrics that you think, okay, this is just specific to Apple, so let me just look at a specific metric and adjust to have an average cash from operations that you can apply to any company for your formula, for your calculation.
I don't think it's quite, no, if I had to explain, here there's the numbers of cash flow for operations, and then I will adjust considering how they use their capex. So how do they use their capital expenditure? So they are spending some money in their business. How is it effective? How are they using? Are they good at using their capital, at using their cash flow and everything, or are they bad at it? So I adjust for that. I calculate what's called maintenance capex.
Okay, I
And
understand what
then,
you're saying.
so I use the cash from operations. I subtract the maintenance capex, and I get my cash flow for owners. So I'm sure there's many errors in what I do, and I'm not really precise in my understanding of everything right now. But for the things that I'm doing, I try to be clear, at least in my head, on what the process is. And I don't try to tweak too much on each type of company and each, I would say, different field for now. So once I have this number cash from owners, I will use this cash from owners. Either I use the last one, so last year, or I use an average of 5 years, or I use, depends. It depends on the quality of the business. It depends on how these last 5 years have evolved. It depends, I would say, on my personal, if I like the company or not. If I like the company, I will do, I will let them have a bit, I would say 2 or 3 years bad in the last 2 or 3 years. And if I hate the company, I will try to have them beat their best goal. So I just try to adjust if I like the company or not. Once I have that, I use a method that's called DCF. So that's why I use the DCF calculation, discounted cash flow. So discounted cash flow, I would say strategy or a way of calculating the intrinsic value is you try to project the cash flows for the years that are going to arrive. So I do it for 10 years. You can do it for 5 years. You choose. Hi to Asus, I don't know, someone came. So
Yes.
I just try to do it for 10 years. And then for 10 years, I try to estimate the cash flows that they will have. Once I have that, there's a little formula and you can arrive to the intrinsic value of the business. So I don't know if I was too long, if I lost you on several parts. I think maybe Christophe did a video on that, on
Yeah.
the whole process.
Scott is asking, so it's a manual formula you've created, and he said that's very interesting. Yeah, that's true. That's some very interesting method of valuation, because if you want, you can tweak every metric you want. You can adjust for capex, net working capital. You can get very complex, so it's very challenging intellectually if you want to it complex. So that's very good. And there are some websites that do the formulation for you, that do the formula, the calculation for you. And I think in the module 1, I covered the DCF, and I said I used Stock Unlock website to do the DCF. I don't have any Excel file to do the DCF. I just put the metric. I said, okay, free cash flow is going to grow 10% per year. I have such discount rate. I need a PE ratio of 20. What is the formula? What is the price target that you gave me? And this website has a price target for me. So this is a website called Stock Unlock, and I think it's in the class 3 or 4, and there is a DCF tool.
Yeah, let me just quickly share my screen, see if I can. For example, I like to, not sure if you guys can see it. This is my discounted cash flow calculator. So, Scott, I mean, I'm not sure if you understood what Ugo said, but this is, for example, what I do, and this is for the example I'm giving here is for Baba stock. The current price is 76. You have this number of shares outstanding, and then you have a perpetuity growth rate. Here we are assuming it's after 10 years, what's the perpetual growth rate for this stock? Assuming this is a company that's gonna continue living for the next many years. And what happens is after that growth period, they tend to grow at the same rate the economy grows. So I'm assuming 3.5% growth. And then you have your desired discount, right? So most investors use 10%. I tend to use 15%. And then you want to use the free cash flow for year 1, the current free cash flow that the company has. And if I do the calculations, look, this, for example, let's assume I want 50% return, on my money. And now let's, if I look at history, let's assume Baba can grow its free cash flow at 6% per year for the next 10 years. And then if this is the case, then the intrinsic value of the company is around 76. So if the company goes on to meet these expectations, 76 is a good price, is a good entry price. But notice that Baba, Someone asked something.
Yeah, Hugo.
I will just cut my my sound.
Oh, okay. Yeah. So
Okay.
I think 6% is quite conservative for Baba. If we look at history, for example, over the past 10 years they grow free cash flow at 24%, but the last 5 years, yeah, they grow free cash flow at 7%. So right now, I mean, even if we assume 6% growth, and if I want a 15% return on my money, 76 is a good entry price. And so, yeah, this is just an example. Yeah, let me stop sharing.
Yeah, and you have some DCF or the reverse DCF that you can use.
Yeah,
And
I find it helpful as well. Yeah, yeah.
yeah, you can put the price of the reverse DCF. Maybe you will explain better than me. It's when you have your target price, no, the current price right now, and based on the current price, you estimate the projections that the market is estimating right now. Am I correct?
Yeah, you're right. So this is what I use. So I want to know in the case of Baba, okay, so what's the price of Baba reflecting right now? How much bearishness or bullishness is reflected in the price? The market uses a whack of like 10%, right? And so if I do this, and if I do instead of 6%, I do -4, this is how the market is pricing Baba. So Baba, I mean, the stock is so depressed. Look what happens. The growth rate is negative. So the market, Baba is priced as though the free cash flow is going to decrease 4% for the next 10 years. Yeah, which is, I mean, I don't think it's possible. Yeah, as I showed you, the return, like over the past 5 years, they grew the free cash flow by 7% and 24% over the past 10 years. So I think this valuation doesn't make any sense, right? Yeah. So what this means is that even if Baba, the market is pricing Baba as if they were going to lose free cash flow for the next 10 years. If they were going to, yeah, it just doesn't make any sense in my opinion.
Yeah,
So
exactly. There is so much pessimism in the market right now with China, the whole market Chinese. Nobody wants to touch it and to invest in Chinese companies. So everybody is expecting Alibaba to decrease their free cash flow. And for the moment, free cash flow is holding quite well. So you can say Baba is cheap for this reason. Everybody thinks the business will decrease the free cash flow, but no, they are generating a lot of cash for the moment. So that's the point of the reverse free cash flow. We have a question from Asus that asked to share the Excel worksheet for the group, guys. If you want to share your files, you're welcome to do it. And there is another question for Seeking Alpha website, if this is a good website or not. I've used Seeking Alpha for some years now, I would say maybe 4 or 5 years. When you look for a company, let's say you want to do some analysis of Apple, you go to Seeking Alpha, you tap Apple, you will find some financials, as we've seen before with Hugo that shared his screen. But you can also read the analysis of guys that wrote articles about Apple, and you can have their views on Apple. I think that's a very good way of not doing the analysis. If you're just curious about Apple, just go to the analysis part and read what other people have to say about Apple. So you can have an overall view of the company. It's a paid website. It depends. Yeah, I think for the free version of Seeking Alpha, you can have, I would say, 50% of the website for free. 50% of the tools for the website are free. And if you pay, I don't know, guys, if you pay for Seeking Alpha, I don't know the price of it, actually. I've never paid for the website.
It's pricey, but I mean, unless you are, my experience with Seeking Alpha, I've never paid a subscription, but you have a number of articles for free every month. Every month you can read 2-3 articles for free, and they are really good. Yeah, so if you are a sophisticated investor And if you really want to understand more about the companies you are investing in, people who actually post articles on our website, I mean, they are really sophisticated investors, and there's a lot of value there. But I think it's pricey. It's really pricey. And if you do your work yourself, there are a lot of other articles that you can actually access for free. But yeah, it's just my opinion. Yeah, but they are a really good website. I think the reviews are really good as well.
Yeah. Jesus, have you tried using Seeking Alpha? Or maybe if you tell us what you want to get out of this website, we can just recommend other websites, for example, for the analysis. It costs $250 per year. So yeah, you divide by 10, $25 per month.
Yeah, I don't think it's really expensive. I know that some other tools like what's the name? Microsoft. I don't know. There's something developed by Microsoft.
I think I know what you're trying to say. I don't.
Something just for normally for professionals. Like I think it's 3,000 or 4,000 a month, something like that. And in general, I would say that it's $250 per month for Canadians.
Oh,
I
that's
don't
a big
know.
deal.
I just checked on internet, and it was $250 per year.
No. It's per month. Yeah, that's why. Yeah, it's very expensive. I find it expensive at least because I can find those articles elsewhere, and I do my own analysis as well. But I mean, if you want to just see other people's work and don't do the valuations yourself, then I think it's a good site. I just find, for example, Christopher and I had been talking about Stock and Lock. Stock and Lock, you pay, I think it's $80 per year, and the amount of information you see there is just amazing. So I think it's really cost effective. Yeah.
Yeah, if you want some idea generation, on Stock and Lock you have a stock screener, so you can get some tips about investing. And let me share my screen real quick. Let's see this. Okay, can you see my screen?
I can, yeah.
Okay. I'm on Stock and Lock right now, and we talked about the DCF method before. And actually, on Stock and Lock, you can do DCF. That's the DCF tab. But you can also do a reverse DCF. If for this moment, when you go to this tab, you have the annual free cash flow rate for the past 5 years, and it just forecasts it for the future 5 years. And if you want to do the reverse free cash flow, you want a fair value at 0%. So you just decrease everything. And as we've said before, everybody expects the free cash flow to decrease. So instead of having 11%, you say minus 10%. And that's as easy as it gets on. Maybe if you want to do it manually on an Excel file, you can. But yeah, as we said, Stock and Lock is maybe $6 per month. So it's really cheap for the value you can get. And that's a reverse free cash flow. For the future, for the next 5 years, next year, you will have a decreasing free cash flow of minus 10% with absolutely zero buyback, with a PE of 20. That's 21, 22. That's the reverse free cash flow. So everybody expects it. And you can get even crazier if you think the P ratio will be 10. Oh, wow, that's some. Nobody wants to invest in this. If you expect the P ratio to be, let's say, 10, you can expect the free cash flow, let's go to 0% of fair value. Okay, if you think in 5 years, the P ratio of Alibaba, I think right now it's 10. So if you think it will be 10, P ratio of 10 in 5 years, well, your assumptions are that the free cash flow will only grow 5% per year for the next 5 years. And on average, for the past 5 years, free cash flow has grown 11%. So that's quite conservative. That's why we said Alibaba is cheap. It's because all these assumptions in the future are very pessimistic. And if you compare the strength of Alibaba, the ecosystem of Alibaba, compare it to other US companies, you don't have the same valuation. The US competitors, they can be valued at a P of 25, 30. So there are many arguments that say Alibaba is very, very cheap right now. You have the same phenomenon for another Chinese company called JD.com, or with JD.com, which is the equivalent of Amazon, and the same for Tencent right now. So yeah, we've talked about Excel files, but you can also do it on Stock Unlock directly. I don't know if that's helpful for you. That's one of the tools that you can have on Stock Unlock.
Yeah, hi, Chris.
Hi.
My name is Raj. I'm from Canada. I was the one who was messaging you with regard to the Seeking Alpha. It was recommended by one of my good friend, and but I have not enrolled it. Just wanted to take your opinion because you are showing Seeking Alpha. So I was just interested in doing that. You can also recommend a good site where we can get different kind of trends and options, right? I would be interested in trading in options.
Trading options. I'm afraid I don't have any special website for options. Maybe guys, do you have some recommendations? But it's a pass for me.
No, I do none. I don't do any
trade in options. Yeah, okay.
Same here. I don't do any options. Yeah.
Right. Okay. Also, I want to know how frequently you would like to meet. It's a good forum where we can exchange ideas because each of us involved in doing a lot of research, spending time. We can exchange ideas and get to know more about insight into the markets and stocks.
Oh, that's up to you guys. I mean, I'm available every day, so
okay.
as many as you want, guys. I just did a poll. I can do it every day if you want. I'm here for you. So if you have questions, I'm here, and I think people in this community know more than me. So you have some good professional investors here. So
correct.
Thanks for sharing. That's not a teaching lesson. That's just share ideas. Come with
share
ideas.
the ideas. Yeah. You can also create a group called Telegram or in WhatsApp where we can share. It can quickly, instead of logging into school and getting the information, that would also be useful. It can be quickly if you have some research information. Let's say you're recommending Apple and you can forward any research report. We can quickly glance it through. Even when you are outside.
Sure, that's a good idea. I don't know Telegram
That's very handy.
But
okay. Telegram is very popular in other parts of the world, Asia particularly, because it can accommodate more than 250 people. I think WhatsApp has a limit, 100 or 120 it stops. You cannot make a group with more than that.
Oh, okay.
But Telegram is maybe 1,000, 800. You can go big number.
Oh, wow.
But WhatsApp is fine to start with, because those who are similar interests, those who are spending time, and those who want to have a similar mindset, we can all come together.
Yeah. Are you like a special option trading guy?
Yeah, I'm very much.
What do you like
also
most
into
about
stocks? Sorry?
What do you like most about option compared to the traditional stock buying?
Yeah, option you can trade in bull market and bear market both. Sideways market also. But equity is only one form of expectation.
Oh, yeah, sure.
Yeah.
Scott is asking about the Think or Swim TOS platform that I don't know at all. Do you guys know this platform?
Yeah, I know it has been provided by TD Ameritrade. I was using it.
Yeah.
Now I exited from TD Ameritrade. I'm using something called Interactive Broker in Canada.
Oh, yeah.
Me too. I use that broker as well. Really good.
Yeah.
It's maybe the best one. Maybe the best one. If you want a lot of reports, a lot of data regarding your portfolio, Interactive Broker is the best. I would say eToro is the easiest one to use, simplest one, the most simple. But Interactive Broker, if you're professional managing big sums, nothing beats Interactive Broker for the amount of reports that you can have. But I would say not for you guys, but for beginners, maybe that's a bit complex to use Interactive Broker because of all the reports. I don't know if you guys would recommend Interactive Broker to somebody that has never traded stocks in their life.
Never.
Too complex?
It's too complex. Yeah. If I were to use eToro when I was just starting, I mean, yeah, I would feel like really I would feel overwhelmed, frankly. Yeah, it's quite complex, and it takes a while for you have to, it takes some time to actually get used to the platform, and yeah, and the customer service is not as responsive. They are not as easily available for you as you would find people at eToro, essentially. So
Okay.
yeah.
Yeah, okay. I think for the answer of how many Q&A calls do you guys want per week, it all depends on you guys. How many calls do you want? 1, 2, 3, 4? It depends if you are available during the week. I think this time is great. In France, it's
Me too.
from
Me too.
5 p.m. to 6, 6:30. I don't know what you guys think.
I agree on Fridays to have at least having this one on Fridays is really good. Yeah, this is a good time of the week. Most people have left work, so I like this. I like this time as well.
Hugo, are you
Yeah.
fine with 1 per week, or do you want more?
No, I think 1 per week is enough. Maybe it depends on the level of everyone. If everyone has different questions on if, for example, DCF, what it is, and others are more keen to learn about, I don't know, maybe other watch list items or watch list companies. Maybe it can take longer than one Q&A, but for me, one is enough if everyone has roughly a basic level, I would say, or is already already knows a bit about what they are looking for in stocks and the price and the quality of the stock.
Yeah, only module 1 has been released. That's normal that we have some beginners or some advanced level.
Yes.
We have some different layers of difficulty in this group. But yeah, I have several projects from this Q&A call. For example, I did a post a few days ago, about we all gather and say, okay, let's analyze Apple for this week. We all compile everything we have, all the research we have, and then we have a call to just gather every research we have. So that's a good way of exchanging about the business. But for this format, we would need more Q&A calls in that sense. And yeah,
Yes.
I think as the module 2, 3, 4 will be released, everybody will get an advanced level. That's the goal, or average level or advanced level. But I think for the module 1, what is missing, I think, is some example. Some example, as you said, Hugo. For example, let's just take Google and do the complete process of, okay, looking at revenue, earnings, valuation, looking at all the tools, but just for one specific company. Maybe I will record it next week, like a 3-hour session, just Google. Let's analyze Google or another simple company. I think it will be helpful for beginners.
Let's do that. Yeah, let's use Google as a good case study. I would agree.
Okay.
Yeah.
Yeah, because for Apple, you have some different revenue recognition for Apple, because you can pay your iPhone, but you can also pay every month, like for 2 years. So the revenue is kind of messed up. For Google, they have like YouTube, Google Ads, and the other bets. I think it's easier like this. And that's a simple industry. Okay. Simple margins. The only thing with Google is that they don't have any competition. So if you want to analyze the competitive advantages, the moat, well, it's easy though. Very easy work. There is no competition. They have, I don't know, 95% market share. That's the main drawback of having Google as a main point of analysis. But otherwise, regarding financials, that's a great work to do. Sorry, I have to rush for my doctor's appointment, Asus. Let's catch up again. Sure, man. It was nice talking to you, and I see you next Friday for the next Q&A call. And yeah, we can definitely share our phone numbers.
Sure. Yeah. Okay. Thank you so much, guys. I'll leave.
Thank you so much, guys.
Bye-bye.
Have a good one.
Okay. Bye.
Bye.
And I feel it is a good time to buy Apple. Any views? Oh, that was the question, but he will ask this question to his doctor. now that he's leaving. Okay, maybe the doctor will have something to say. Well, that's for the next call. We don't know. Yeah, okay. So I think that's done for the recording, or maybe Hugo, you wanted to spend some extra time to add some names to your watch list. Maybe that's part of the recording. I don't know. The free meeting will end in 4 minutes, but we can do another 30 minutes of Hugo showing his watch list, and let's talk about the names you have on your watch list, if you can improve it, etc. As you want, guys. I'm free.
Yeah, I will be glad to show my watch list, and if you have any suggestions, anything about that I could add, I would add it gladly. Yeah.
Oh, sure, let's do that. Okay, so let's do the same thing. I'm repeating myself for Scott. I will end this meeting right now, and guys, just wait 30 seconds, 1 minute, and click back on the link.
Yeah, I'm gonna have to hop off. You guys have an amazing one. I really enjoyed meeting you, and speak to you guys next week.
Yeah, sure.
Have a lovely weekend.
Chris, sorry, guys. I got one question.
Yeah, Scott.
Did you see my last question? Is that I want to follow these guys. Do I have the right guys, Hugo and Eduardo?
Yeah, I'm Hugo. Yeah.
Eduardo is
what
the
does
good.
It mean to follow me? I don't really understand.
On the in the investing masterclass in the school
platform. So every time you will post, you will get notified.
Yeah.
Okay. Yes. It's my name. Yeah.
Okay. Thank you.
Yeah. Yeah. If you can follow me, yeah, if you want. Yeah.
Have a good weekend.
Yeah. See you
weekend.
soon. Bye.
Bye.
Just the two of us, Hugo. Just the two of us.
Christophe, do you want me to share my watch list?
Yeah, sure.
Yeah. So here's the work that I've been doing for the last 6 to 8 months. Each row I have the names of the companies, and I have my analysis here on this link part. And afterwards, I have my value, or the intrinsic value that I think for the business.
Yep.
I have to update it for the new year now, so 2024. Some of them I haven't done them yet. I'm still on the 2023 value. And so I have several questions, but my principal question would be, do you have any suggestions of companies that I could add to my watch list? I would say in general, if you have 8-tier companies, because I've analyzed now, I would say thousands of companies maybe in the last 8 months. Most of them I didn't even look twice, and I didn't even put them in my spreadsheet because they were too awful. But I've analyzed maybe approximately 200 that are to the end, I would say, so start to finish. And in the total, there's maybe, you can see here who's in the A list.
What does A mean?
I can show you afterwards if you want to. Yeah, here I don't know if you can you can see it on the side. It doesn't show on my screen, but normally A is for 30% more ROIC.
Oh, okay.
So I rank companies by the ROIC. Is the business, so it's ROIC is maybe a combination of good business plus mode, because if you have such a good ROIC, you must be crushing the other competition. Well, it depends in general, but I would say that for me, ROIC is really important, because if the business is growing fast, plus it has lots of margins and of return on their investment, then I think it's just a great business overall. So if you have any suggestions of companies that for you are above 30% ROIC, I will gladly add them to my watch list.
Yeah, sure. Just for your watch list, the key components of your watch list are the price and value, so the gap between the intrinsic value and the current stock price. And the other metric is the ROIC. So you can do a magic formula thing and a ranking. If, for example, you add I would say, add a column, the ratio between the intrinsic value and the price. For example, for Apple, you have a current price of 170 and the intrinsic value that you calculated at 65. So you can put, I know, if you want a column 65 and you divide it by 170, you will have a, I don't know, 80%. Or you can do the reverse. You divide the price by the value and you can say, okay, it's 150% overvalued. You take this ratio of percentage and you add another column of the ROIC, return on invested capital, and you can do a ranking out of these two metrics, the overvaluation percentage and the return on invested capital. And based on the different weighing that you want, you can have a ranking. Okay, based on my watch list of 200 companies, this is my best opportunity compared to undervaluation and high ROIC. That's a magic formula that you can do manually.
Yeah, I think it's a great idea, but for now, my plan is just to look at companies that are in the I would say in A, B, or C maximum categories, and that are turning green. So each company that is turning green is the company where the value is above the price.
Okay, I see.
So I don't. For now, it's a great idea, I think, to divide price to value and to have more information on if that's the best choice for now. But I think it's I can access, or I can achieve the same results if I just look in my column which is green and which is at the top of my ranks.
Yeah, sure. For the A, B, C status, if you only have
Yes.
3 things that are green, 3 things that are a buy, that's manageable.
Yeah.
That's manageable. Okay.
And once it's there's not always for me there won't be ever 10 companies that I could buy maybe in the crash like in the COVID era. But once I do that, and I know that every company is a cheap price, so I would say I put a 15% margin of safety on my value. So if all of them have a value that is better than price, then I will just look at their ROIC and I would say the quality of the business in general, and I will take the best quality of the business. I don't. 50% margin of safety is already good enough. If it's like 70 or 80, it doesn't. I prefer to have first best companies with ROIC, so best quality of companies, and then the price has to meet the margin of safety.
Yeah, for all the intrinsic value that you've written here, you put a margin of safety of 50%?
Yes.
Okay. So that's quite conservative. You don't get the opportunity
Yes.
to buy at a 50% discount every time. That's very rare, actually. Most of the time, you have 30% margin of safety. So that's why you have so few buys, so few green sales, because that's a 50% margin of safety. Okay. I see that.
I'm really conservative for now. I haven't been doing this for much, and I'm not taking I'm not risk assertive, I think the correct word is. I'm not huge on taking gambles and so for now I'm trying to be solid on my techniques. If I'm a bit more competent and I would say I'm more sure of my knowledge, I will change some of them and I will try to be a bit more less conservative.
Yeah, you want to be more risk averse when you're sure of your thing. Okay, this is a pure deal.
Or just that I'm been doing this for longer, because confidence also comes with time and past success. So
absolutely.
So maybe I would say it's not. I don't know much. I don't know a timeline, but maybe in 3, 4, 5 months, maybe more, 1 year, maybe tweak some of the margins of safeties and also some of the ROIC, because I do a certain calculation, but there's many things that I don't take into account, many things that I don't know yet. So um, even the value that I estimate will change over time. So
Yeah, and that's great that you've created this big watch list with your favorite metrics. And as the quarters pass, you will get more and more comfortable with these companies. So you can adjust it if you think this doesn't deserve the 50% margin of safety, but it's such a quality business that you can pay a higher price. As the months pass, you will be much more comfortable with these names, and you will know which business deserve which business deserves a higher valuation with higher ROIC, etc., etc. So that's very good. You have 200 companies on your watch list.
yeah, but I would say 30 of them are correct, and all the others are rubbish. Just at the start, I was doing the analysis for each of them, each company that for me could be a potential buy. So I would say I did a super quick look at the balance sheet and all the financial statements, and I tried to assess if the business was good or bad, just really super fast. And if it was good enough for my beginner eyes, I would say, then just did the analysis, and I would try to say, oh, maybe my eyes were correct or my eyes were completely wrong.
Yeah.
And you can see that for now, my eyes are completely wrong. So I have the big names because everyone has the big names, but in finding any so many of the companies that are on my watch list are I would say rubbish or very low grade companies compared to the best. But that way I would say I can rank them, and I know more businesses and how they cheat also their numbers. So I would say they make it look good by having last years that were great, having earnings that were that had improved a lot. But if you look deep in the numbers, they're not.
Yeah, that's a great mindset to first, if your eyes are right, as you said, you add the stock to the watch list, and then you do the proper work, complete analysis, so you can put the stock in the garbage, or you can keep it in a watch list. That's a great mindset. And yeah, for sure, you have plenty of companies that only reveal their earnings for this year, and they only compare it to the earnings from last year. And year over year, maybe you will have a good growth, but if you take the past 5 years, you have some terrible results. And we've seen this many times. I remember Robinhood in the investor presentation, they had their losses and their earnings. The earnings were in green and the losses were in green. So if you don't know, if you're bad with colors, you just see a green, but it was a darker green for losses. Oh wow, terrible! And that's just misleading. Put your damn losses in red. That's you can mislead the investor in many ways, and you can adjust for every metric. That's why many businesses in their investor presentation they have their adjusted EBITDA, where it's completely inaccurate and is the earnings that they want, basically. Not that they have, but the earnings that they want. These are adjusted EBITDA. So you will see for the past 5 years, 10 years, adjusted EBITDA will always go up. That's strange, but the real earnings will not go up. So yeah, you can twist, and that's good that you do your own valuation to just correct, adjust for every metric that management likes. And if, for example, a management is paid for the, I don't know, adjusted EBITDA metric, it is incentivized for boosting the adjusted EBITDA. Well, it can make a huge difference to the stock price over the long term. So that's some very good work. Do you want to go deep on a specific company on your watch list right now? For example, the buys or competitors for a specific company?
maybe not. There are two companies right now that I would say are interesting on my watch list. So interesting meaning I haven't bought already, and that could be future buys. And those are, I think it's Fortinet and Ramaco Resources. I don't remember what they are in my watch list.
Yeah, I've seen
Uh,
Fortinet
Ramaco here.
at the beginning. Ramaco Resources, okay.
Fortinet is here. So those are right now the ones that are closer to their intrinsic value on my calculations. So some of them maybe I did it 5-6 months ago, and I tweaked a bit my formula. So I need to recheck that I've
Okay.
updated everything. But if we use those numbers that I've put in here, there was Fortinet that was a possible buy. If it's really a 43% ROIC, then it's so it means that in less than 2 years, it will reach the no, because I do a margin of safety of 50%, so it's already close to the price, and it's sure that in less than 1 year, if I'm correct on my ROIC, then it will out. It will be above the current price.
Yeah, it's just that you put a 50% margin of safety. So you
Yes.
double your value. So instead of 30, it's 60. So
Yes.
the intrinsic value is close to the current
Yes.
price. But if it grows 20% per year, 30% per year, yeah, that's very good news.
Yeah. So there's this company and the Ramaco also. Both are close to their intrinsic value, and both are the right now, and they are the only ones on my watch list for now that are possible buys that I didn't buy, I would say.
What do they do, Ramaco Resources?
I've done it a while ago. I think it's a mine. We can check on Seeking Alpha if you want.
Yeah, sure.
Often I need to put down. Yeah. I don't remember when I did it. You can check what they do.
Oh, we can't see your screen right now. We are blocked in the
you cannot
Google
see
Sheets.
it.
Now we see your face.
Yeah, I will share my screen. Does it work?
It's loading. Let's see. Yes. Okay. Seeking Alpha. Yes.
Yeah. So it's mine.
Medcall. Okay. Medcall. The Medcall segment in 2023, 2024 is having some good traction. You see some good investors like David Einhorn investing in Medcall, Manish Pabrai investing in Medcall. So yeah, that's why in your watch list, the intrinsic value is quite high. Is that the earnings has been so good in the quarters, I would say. That's definitely an interesting company.
But I don't. Normally, I'm not biased too much on the last years with my calculation because I do a 10-year, I would say, estimation, and I try to average everything. But yes, right now for me, it's a great field of business, and I don't know more about it. So for now, I'm just on the analysis of the numbers, and right now, so I'm the process to convert to a buy is can I understand the business well enough, and am I right about my projections in general?
Yeah, because it's a cyclical company, the 43% ROIC that you found can vary a lot. And if you look at 2020, it was terrible, I presume. What is interesting about Medcall is that in this industry, okay, they sell metallurgical coal. So you have two types of coals. The coal that you burn to make a fire and produce energy, and the metallurgical coal that is used to produce steel, and steel is used to, I don't know, to build bridges, roads, etc. Very, very useful, especially in China and India. So met coal is different from the other coal, I would say. For the met coal industry, you have, I would say, medium-term contract that are paid in advance. So for, what's the name of the company? Ramaco Resources. I think if you dig and you look at their website, in the earnings release, maybe they will tell you, okay, for next year, for the whole year of 2024, we have committed this amount of tons of coal that we will sell for this price. So you can say, okay, for 2024, the earnings will be this amount, I don't know, 80 million. This will be forecasted really easily. That's why it's really enticing, sorry, to invest in the met coal industry right now, is that I would say, the met coal prices have increased so much in the past quarters. And at this time, these coal companies have locked this high price. And they say, okay, let's just look for this high price for 1 year, 2 years. That has been the case for many met coal companies. So what would be very interesting to work on for Ramaco is to see the earnings release or investor presentation and see the commitment that they said that they released. Usually they say it, okay, it's 70% committed. The price is fixed, but maybe it's not 100% fixed. Maybe it's 50% fixed and the other 50% is variable. We don't know, but at least 50% is fixed. So you can estimate, okay, on a probability range, I'm fairly sure that this will be the range of these earnings. And because met coal prices has been so high right now, the return on invested capital of 40+% that you see, this is the reason why they have been producing so much cash flow. And depend on the inside the met coal sector, you have different companies with different balance sheets. For example, I don't know the balance sheet for Ramaco. Maybe they have a lot of debt, they have a lot of cash. Have you done the work to see their balance sheet?
Yes, but I don't remember. I did it a while ago. We can check now. Check out now if you want.
Sure.
Where? Oh, no. Where is it? That's the last report. How can I slide to the right?
Okay.
Here. No.
Total cash and short-term investment, 40, around 40.
And that is here.
And that is about 30, 40. Okay, so no net debt, no net cash, approximately 0. And can you see how much cash they have generated recently, like next year, for example? Cash flow generation.
Operations? Yeah.
Oh yeah, good enough.
You want maybe 160, yeah.
I'm sorry, and you have a capex of 80. So yeah, they produce. Okay, so the balance sheet is insignificant because of all the cash flow that they produce. So this was not a big deal, and this will not be a big deal because they can pay their debt very easily to be net cash. They are already net cash, so that's not a problem. Yeah, what I would suggest, what's the market cap of the company? Because you have a free cash flow of 80, that's in billion. Okay, so market cap of 800 million. They produced 80 million of free cash flow. So price to free cash flow of 10 approximately. Okay, approximately. Yeah, what would be very interesting is if in the past there were commitments, fixed price, fixed volume, that would be very interesting to look at this and then compare it to what they project. They will say they will do in 2024. And I think if you have the good information, and if I don't know if the last earnings report, they said that all their sales are at a fixed price and there is a fixed volume, well, you can say very easily the earnings that they will produce in 2024. That could be a good catalyst if you want to buy a stock, because your projection is very, very easy.
Yeah, but what in what you said about the business, if it's cyclical and if it's, I would say, more trend business right now because coal is really hyped, I would normally not invest in it. I'm not interested in. I would say if the mines or any the raw material of coal is really hyped right now, I don't think it's that much of a good long-term investment. I would say long-term mean more than 5 or 10 years,
Oh yeah,
which I'm
definitely.
currently looking at. So I think I will just pass on the business. And also, I didn't look at the market cap, but normally I try to find businesses that are above 1 billion market cap.
Okay.
So yeah, I think it's a pass just from those information. Maybe I will look at the website to look at the future earnings, but yeah.
Yeah, that's definitely a pass.
For
That's
those,
100% cyclical. So maybe in 3 years, everything will
yeah,
change. And
yeah,
if you look at 2020, it was disastrous, disastrous, and the sector was hated.
yes,
And now everybody loves the met coal for any reason. And
yeah.
now,
So I won't go deeper into
yeah,
it.
yeah. So it's definitely a pass. If you don't like cyclicals, definitely a pass.
Yeah, yeah,
For Fortinet, it's not a cyclical.
yeah. I don't remember what Fortinet is.
Cybersecurity stuff,
Ah,
FortiGuard,
yes, maybe it
etc.
was because um, why does it done Fortinet?
FTNT.
Okay. FT. Maybe it was because Nancy Pelosi invested in it that I added it to my watch list on another cybersecurity company.
Yeah, I
Uh,
think
but if it's cybersecurity in general, I like the type of business. I think they can defend in general their moat, or I would say their field of business is not going to shrink too fast. Um, so maybe it deserves a second look. I don't know if you have any thoughts on it, on the business, or if you know the
yeah,
company.
I've been a shareholder of Fortinet in
Okay.
I bought in 2020. Every other cybersecurity company went up, and then Fortinet went up and then down to COVID lows. And the other companies went up, and Fortinet went down. So it was just intriguing. So I've done a deep dive on the company, liked what I saw, no debt, cash generative, led by two brothers, founders that have been in the company for 20 years, something like this. And they own 15% of the company, 20% of the company, something like this. But there is a very high insider ownership, above 10%. So the founders, the two brothers, they own more than 10% of the company. And it's led without any debt. And it has been growing 20% per year for the past 5 years, 10 years. So you can like a lot of things for Fortinet. And I bought it at a P of 30, something like this. It was, I think, in November 2020, around this time, and held it through 2021 and sold it. Okay, you see, this is the chart for Fortinet. COVID lows and then a quick rebound, and then it went down for absolutely no reason until the
Yeah.
end of 2020. So I thought it was a good time. A bit expensive, but a good time. And then it went up and
Yeah.
up and up and up and up and you see the beginning of 2022, there is a decrease in the stock price. I sold that December 2021, something like this. The PE went from 30 to 70. And it was just too much for me. I said to myself, okay, if it drops 5%, I'm down. I'm out. And it kept going up and up and up and up and up. So I said, okay, if it drops 5%, and I was out at this moment. But I love the business. I love what they do. The problem is valuation. The problem is that they've grown so fast and so well over the past 10 years that everybody expects them to continue to grow like this. And if they have a small problem of growth, the stock can derate. The stock can have, the P ratio can decrease from, what is the P ratio right now? 50 40, 50, something like this, it can go back to 25 really fast. So that's, I would say, the main risk for Fortinet, not competition, because I think these kind of businesses have some great switching costs. If you want to change your cybersecurity provider and you want to go from Fortinet to Palo Alto Networks, for example, wow, it's a pain in the neck to change everything. So just you have Fortinet, you keep Fortinet, even though
Palo Alto is just right here.
oh yeah, yeah, they can boost their prices every year and they will keep their customers. So huge moat, in my opinion. That's and very good margins and return on invested capital. That's 43% here. Okay, so and for the other company, what was the Metcall? Okay.
Ramaco, it was 25, I think.
Oh, 25. Okay, I said 43, but yeah, okay, definitely good.
Yes, yeah, no problem. Great company. So yeah, so you would advise. Normally, I don't buy if there's no margin of safety. So it's just that I'm trying to understand if I'm too conservative or not. So right now, yeah, it's great to have all these informations, and definitely for now I keep it on my watch list, and I don't know yet what I'm going to do with the stock, but still think that it's a great business, yes, and still think that I will look closely if the price evolves and if it's maybe a margin of safety of maybe 20 or 30%, then I will buy. I think the business is really great.
Yeah, and it can happen really fast. I think in their latest earnings report, quarterly reports, the growth has decreased from 20% growth to 8% growth. So a big shock. Oh, wow, the big grower is not growing anymore, but still growing, but less fast. So you can have some derating. You can have a P ratio that goes down to 30. Now, I think we've seen on Seeking Alpha the forward P ratio, so the earnings for next year, and it's at 40, but it can drop to 30, and it won't be cheap. I mean, it can drop 33%, 1/3, and still not be crazy cheap. So yeah, the main point is forecast, estimates, growth. Is it still growing or not? And valuation. But all the other metrics are very good. All the margins, customer retention, the moat, the competition. That's a very good company. And founder-led, so high insider ownership. They won't mess up. It's their baby. They won't do anything stupid. They want to invest for the long term. And yeah, crazily good, I would say. The main problem is the price, as you've said on your watch list.
Yeah. Great overall. So those were for me right now, that are only the two that were possible buys. I think the market, as we discussed previously, I think the market is too high for 9 or 10%, as Damodaran said in one of his videos. And I think also he said it on television. I don't know, CNBC maybe? Yes, CNBC.
Oh yeah, he does. He comes to CNBC.
Yeah. So often I look at CNBC and I try to see what he says, and so yeah, he said that, and I agree with him in most parts. There's nothing that I don't agree with him. So I totally agree that for me it's too expensive. The market is overall too expensive. So if in other consideration, if you have other A or B tier list companies that you know, that you think could be a great, that I don't have right now, or just you give me the names and I will check that I don't have them even.
Oh yeah, okay.
That I could analyze, and next time I can even show you what I did on them and which value I thought they had, and if maybe I'm correct, or if there are other possible buys, then it will be a great news.
Oh sure. Let's complete this watch list of high ROIC. I mean, if you can build a watch list with every company with the ROIC above 30%, 40%, you have a bunch of great quality companies. I don't see Ferrari on your list. I don't know if you have it.
Yeah, normally I don't touch at car manufacturers because they have I cannot imagine how they have that much of ROIC, but I will check it.
That's crazy. This industry is quite phenomenal, and you can do the same. It's not cars, it's a brand. They can double
Yeah,
the
okay.
price and people will buy a Ferrari. They don't give a damn of the price of. And you can say the same thing about Hermes and LVMH, the Louis Vuitton bag. You can double the price
Yeah,
of a
I've
Louis Vuitton
already
bag.
looked at them.
Yeah, there will be some millionaires, some Emirati, some Chinese customers, especially for Louis Vuitton, that will buy the price regardless. That will buy the bag, sorry, regardless of the price. So the luxury brand, I think, could be a great addition to your watch list.
Yeah, I've added them, but for LVMH, I think the price was so incredibly high, like the price of the share, that I said no, I cannot. There will never be a discount, or there will never be a margin of safety on those types of businesses. People love them too much, and I think
Yeah.
they love them too much. So it's irrational love.
Yeah, never. And same for Hermes. It's even more extreme with the Hermes. It's
Yeah,
for
so I will
LVMH.
look at them and I will add them. Hermes, I didn't look at it.
Oh yeah, for LVMH, I think in 2022 you had a P ratio of 25. Okay, reasonable. Like on the low end, it's 25,
Yeah.
so quite expensive on
Yes.
average, etc. But that's a
Yeah.
quality company. For Hermes, he never dropped below 30. He never dropped below 35, maybe, but that's just
Yeah,
extreme.
wow.
And these companies have been so good, and they have been existed for 200 years.
Yes.
Unbreakable. You can't kill them. And
Yeah.
I could bet a lot of euros to do bets that they will survive 100 years, 200 years. You can't do the same for Google. You can't do the same for Apple. Nokia in the past was incredible company, a huge ecosystem, and then got destroyed. Apple maybe will have the same fate. But for Hermes, Ferrari, Louis Vuitton, they have the brand that can last for centuries. So that's why you have a constant premium, and there is never a discount. There is never, you need some specific event like a pandemic to have them drop to a reasonable valuation. But apart from that, you will wait and wait and wait. That's some special situations.
Yeah. Yeah. So yeah, I completely agree with if they have such a great moat, yeah, it's sure that their ROIC is through the roof.
Yep.
But I would never invest. I don't. They will never be cheap, and I don't think they will never be. I would say easy multi-bagger, because they are already quite well priced and quite well followed and quite big companies. So I don't think that there will be ever a great buy price or a great investment idea of buying Hermes.
Yeah.
So if you have other companies, maybe smaller or in other fields that you think are great, or things you are looking at right now, maybe could be another addition.
Oh, sure, sure. Right now, I'm afraid I don't have the time because I have to go, but I'll make sure to send you a message with other brand
Great.
names like this. But it was really nice talking to you, and let's have a call next Friday.
Yeah, great. Thanks for everything. Thanks for sharing your knowledge and sharing your time.
My pleasure.